Okay, so let's begin with this week, the final session of ASTC 2014. And before I start, just let you know that I'm now in Hong Kong, and this week I'm actually with my mother. So if the internet connection is not because the slow delay is not because of StarHub, it's because of the Wi-Fi here in Hong Kong. So I do my best to make sure the recording is okay. And without further ado, let's begin the screenshots. Okay, so here we go. So this is final session for batch number 2, and today's date is 23rd of June 2014. And this is the disclaimer. So you have seen this at least 5 times, at least 4 times. So understand that what we are doing here is for educational purposes. We are not giving any form of investment advice. If you decide to follow any trades or trade case studies, examples, this is your own responsibility. We are not responsible for any financial losses. So this is session number 5, which is meant for wrapping up, putting all the pieces together. But before that, we need to finish off the bonuses arising from session number 4. And before even we touch on session number 4, I would like to clarify something with regard to what happened in the Facebook groups. So I thought it would be useful to see some examples, because there was a trigger that happens last week, last Friday. This is Save Airline or Spirit Airlines, ticker symbol SAVE. So we have got a channel breakout setup. What happened was that the entry price was set to be 64.06, which is the 55-day high plus 10 cents. The stop loss as of Friday, 55.92, which is the 20-day low minus 10 cents. So that is a valid setup. And why do I say that? It is because if you look at the ADX below, now once again, the question that I always get is, how do I know if this is a valid setup? Very simply put, the setup is valid for 2 things. One, I see the 55-day high, which is a flat line all the way back in April. It has been a flat line, so that's good. The valid setup requires the 55-day high to be either a horizontal line or a sloping or line that is sloping downward. Okay, so that's number 1. 2, I need ADX to be up. Now the question that Andrew has, which I want to clarify at this moment, for those who have not seen the question in the Facebook, so I would like to clarify this. This is not an intraday trading system. We put on the trade order. If it fails, then we are in. If it doesn't fail, we will cancel. The order should be cancelled, and we will look for the setup again on the next day. We go in every single day for just a couple of seconds. Valid setup, we place the order. Not valid setup, move on to the other trade. So this is not a trade order that we put in for 20 days, 30 days, hoping that the order will be filled eventually. No, this is not true. Our job is to consider the validity of the setup every single trading day. So assuming last week, last Friday, the setup wasn't filled, what will happen is that the order will be cancelled. Tonight, before the market open, which is just 55 minutes away, you can then look at the order and decide for yourself whether this setup is valid. And if that is a valid setup, you place the order and wait for the market action overnight. You will then sleep. You don't care what happened during the day because you are sleeping. So I thought it is very important to understand the technical behavior of this setup. We are doing end of day trading. We are not placing the order when the market is in action. We should be sleeping. We should be doing something else. So that is a valid setup. Okay? So if you have got this setup in, you will have been down 20 cents, which is pretty much okay, because typically a channel breakout setup, you have to be very patient. If it happens, it happens. Does it mean that a channel breakout will always win? No trading system will always win. So we'll just follow the rule by looking at 2 things. One, when the stock hits the 20-day low, minus 10 cents, so which means that the 20-day low will always be either staying along the same level or moving up. This is very important. We are not going to move the SL, the stop loss, down. Number two, if the stop loss is not hit, however, the ADX crosses above the 40 level line, we will then wait for the B short. B short means as long as ADX comes down, after it crosses above 40, we are out. So the last safe entry, which happens back in February, was pretty much because of the B short. I mean, if you have watched the recording back in session 2, I've explained this. So now we are waiting for either the stop loss is hit or the ADX crosses above 40 and come down. So be it. You have to understand that this system is supposed to be simple. Simple in the sense that we do not impose our own opinion. We do not change any features of the rule. Because once we decide to do this, what will happen is the system will generate lousy results. This system is very, very powerful in terms of the results. But the moment when we tweak the system feature, what is going to happen is that you will see your accounts down. You will see your accounts not, you will see this system not working for you. And it has been proven by my mentor many years ago that this system is overall profitable, so long as we keep track of the rules. Okay, so I just want to take this opportunity to make sure that we all understand that it's a valid setup. And therefore, if you want, you can track the trade. You can do paper trading on this and see what happened on this trade. I'm not here telling you that we'll eventually making money. Okay, so this is the first thing that I would like to clarify. Now, let's come back to the slides. Okay, so the slides we have got bonus number 2, which is high probability iron condor spread. And what is going to happen is the fact that I'm going to introduce 3 versions of iron condor. I heard the feedback of batch 1. I heard the feedback in the sense that because of some inability of opening a decent account in Singapore, I have been told that the commission is going to kill quite a lot of people. So I have considered this, taking into account the feedback of batch number 1's people. I've decided to tweak the rule by asking people to go for Russell 2000. Now, because we are trading Russell 2000, which is an index, we need to be very careful. So before we talk about Russell as an instrument, let's talk about what's an iron condor. What is it? An iron condor is a combination of out-of-the-money short call spread and an out-of-the-money short put spread. That's it. That's the analysis of an iron condor. What's the max reward? The max reward is always the credit you receive upon initiating the trade. What's the maximum risk then? It is the difference between the strikes less the credits you received. Why would someone put iron condor? It's because it is a high probability trade. Our job is to collect premium. Our job is to create a high risk, high probability trade where we are putting probability in our favor. That's the feature of iron condor. The risk is high. It is a reflection of high probabilities in theory. That's the classic way of analyzing iron condor. So I'm going to introduce 3 versions. We call the longer term, the long term, and the super short term. This is a reflection of what I was told in batch 1. We said, in batch 1, for those batch 2 people, let me just make sure everybody is on the same page. I said to batch 1 people, let's just do ETFs, SPDR or IWM. IWM is the Russell 2000's ETF. SPDR is the S&P 500's ETF. Feedback from batch 1 was commission is very high. Now, of course, because of this, I said, okay, you may want to look at index option. So the version that I'm going to introduce is the 60-day iron condor version. 60-day in the sense that you will initiate the trade using Russell 2000 as the instrument, and you are going to create a condor where the options have 60 days to expiration, DTE days to expiration. So what will happen is that if you are now in July expiration cycle, we must be looking for August option. Assuming August option has 60 days to expiration, which is not true because August option has pretty much like 55 days to go. So what will happen is that when I say 60-day version, it doesn't mean that we will fill on the day where we have 60 days to go. You are able to continue looking for the trade or continue putting the order in to let it fill. However, when the date to expiration is only 50 days, you have to forget the month, wait for next month, which happens sometimes. Okay, this is quite rare. However, we give ourselves 10 trading days to get this trade filled. How to construct a trade? One, this rule is something that I intend to apply. When I say I intend to apply, I mean that I personally apply, but I have not officially introduced anywhere in my curriculum. That is, Russell 2000 should not be in a strong trend. And some people might ask, what do you mean by strong? So let me be very objective by saying that ADX is below 30. Now, if you remember in session 2, we say that when a trend is strong, ADX is shooting up, and we even have an ADX, we even have an exit for B-short, which means that ADX crosses above 40 trend. This is a high probability trade. We want Russell not to move big. So that means, counterintuitively, we want ADX to be low. That's the whole point. And what we do is we sell a 10-point put spread where the short put has 14 delta or below. And for the call side, we sell an out-of-the-money call spread with a short call that is 10 delta or below. Typically, 14 delta for put, 10 delta for call should be fine. That being said, it really depends on the option chain on that particular day. You may not find an exact 14 delta put. What do you do? So you may have to look for 13, you may have to look for 12. Okay, it all depends. And how do you get out? You exit the trade when you make 10% return on the risk capital. You will exit the trade when you incur a 15% loss on risk capital. This is not a system where we will talk about adjustment. When we say adjustment, I mean I am adjusting the trade to minimize my loss. No, as long as we hit 15%, we get out. As long as we make 10%, we'll get out. That's how simple this system is. So now I'm going to show you in terms of a trade that I'm looking at. For Russell 2000, the one thing that I need you to notice is that here we have got RUT in options analysis. And you notice that option analysis does not have RUT Russell 2000. Now, the problem with Russell 2000 is that if you use it, you've got to understand one thing. Option analysis does not have the data. The reason is that I have talked to the founder of option analysis, and he said to me that Russell 2000's feed is very expensive. So whenever you do Russell 2000, you need to understand that you cannot use OA. So what do you do? So two things you can consider. Number one, for those people who have platinum, you can use platinum. For those people who don't have platinum, you then need to look at the option chain. So what I'm going to do now is I'm going to open up my Thinkorswim account, paper trade. I want to show you how to do it because I have told you guys not to subscribe to platinum or not even consider platinum. So I'm not going, Colin is okay. I'm not ask you to look at platinum. So allow me to open my paper trading account for Thinkorswim just a while, and I will show you how it works. It will take a while. So while the Thinkorswim account is being opened up, because I do to wait for a few seconds, I'm not going to waste time. I'm going to the version, which is here. 30 days is everything the same, except the days to expiration is 30 days. So what will happen is that you have a 6 version, you then 30-day version. So 30 days is high probability iron condor. What you do is that you initiate the trade from 30 days to the 60 days. You are going to stop looking for a new trade when the DT is down to 21 days. So be it. It's only this, okay, it's only this difference that makes the 60-day and the 30-day different. Otherwise, the entry criteria in terms of how you construct a trade, the delta, and how you exit the trade are more or less the same. In fact, they are the same. So the last one that I'm going to talk about, I'm still waiting for my POS account to open. So I'm going to introduce the third one. The third one is something that I would not recommend you to do unless you are pretty confident in doing it. This is called the Ferrari version 4-day iron condor. 4-day iron condor, you open the trade every Monday night using weekly options. You will only open the trade after the amateur hours, 10:30 a.m. Eastern Standard Time. So right now for Singapore, it will be 10:30 p.m. our time. You will only look for the trade after 10:30, and I'm being conservative myself that sometimes, depending on my teaching schedule, I may even look for the trade after 11:30. And why do I do that? It's more or less because I want to avoid the amateur hour. Amateur hour is defined as the first hour of the trade. Okay, so there is a reason why we want to avoid that. Amateur hour tends to be very volatile, and sometimes what is even more interesting is that how we construct the trade pretty much relies on the first hour's price action. So what we do is we wait for the first hour to open first. And then after this, we'll place the trade. How do we do it? First of all, we again use the same delta rule, except one thing now. The thing is that we are going to create the trade whereby the credit has to be at least $1. If you put up a trade and it cannot give you $1, or let's say if you can create a trade with only 80 cents credit, what do? You pass the trade, you don't do anything. Okay, so this is the important part of a 4-day Ferrari version. When I say 4-day, that's actually Monday, Tuesday, Wednesday, and Thursday. You exit the trade when you can buy back the iron condor for 20 cents, which means that you make 80 cents profit. And you exit the trade when iron condor is worth $2, which means you will take a loss of $1 and go. This one, you have no chance to adjust. It's either you make it or breaking it, because you have only 4-day version. So my TOS account is up, so I want to just show you how it looks like by moving my TOS account over. Okay, so this is my paper trading account. Okay. Okay, so I'm going to the trade, Russell. One thing I forgot to do is to adjust the what we call the font size. So right now for August option, we have 52 days to go. 52 days to go. So when I say okay, we can put in the 60-day version with 50 days to minimum, which means that if I am going to do it only now, 52 days, I can only open the trade tonight. If it doesn't fill, tomorrow night will be my last day. If still can't, sorry, we move on. And what we are looking for is a delta 14 for the put side. So allow me to open up the strike price a little bit. So I've got a 14 delta, which is at 1090. So I'm going to sell a 1090. Then we'll create a 10-point put spread, which means I sell 1090, buy 1080. Okay, and you know what? Can I suggest that I continue? I continue, but I'm going to reload my account so that I will open a larger font size. So let me close up my Thinkorswim account. I'm going to do it one more time. This time I'll turn the font size bigger so that everyone can see. So while I'm doing this part, allow me to finish off this version by telling you something that everybody must note. Since we are dealing with Russell 2000, it is an index option. The settlement rule is very, very different. Since we have got a 60-day version and a 30-day version, so we call this standard Russell 2000. They are standard because they are not the one that has weekly option. Okay, so let me say this now. You are going to understand one thing, whereby last trading date for Russell the 2000s option is the third Thursday of the month. Not third Friday, third Thursday, which means by 4 p.m. Eastern Standard Time, that month's Russell 2000 options cannot be traded anymore. That is it. You can't do anything. However, the settlement is on the third Friday morning. And what it means is that you would need to wait for the settlement of the settlement price, which is determined based on the opening price of all 2000 component stocks. So you will not know exactly when the settlement value is available. Practically by experience, the settlement price should be readily available at around 1 p.m. Eastern Standard Time. Okay, that is the way settlement is determined. You won't know the settlement price immediately. You've got to wait for a few more hours. Typically by 1 p.m. Eastern Standard Time, you would know. And for weekly Russell 2000, the last trading day is the same Thursday of the week. So let's say if I'm going to open the trade tonight, you've got to understand that the last trading day is Thursday this week. The settlement is the same Friday of the week, again based on the opening price of the 2000 component stocks. If you decide to let settlement, you have decided to use that to let settlement determine the fate, you need to understand that after Thursday, you cannot do anything. So if the trade is ruined because of some spike, some gap on Russell 2000, you've got to understand that the loss will be incurred. You cannot do anything. This is called the settlement risk. Now, I have got my account open already, so let me see if I can give you a better look now. Okay, so just come back to Russell 2000. So the ticker symbol is RUT. Okay, so I've got the August option, which I said I'm going to look for delta 40. So I said 1090. Okay, and then we'll sell 1090 by 1080, which is a 10 point. Okay, and then we go to the call side, look for delta, which is 10. Now we have 11 here, so cannot. We must be only looking for 10 or below. So the one that we can look for is an 8 delta. We sell 165, which is a 1270 strike. We then buy a 1280. So this is a 10 point. Now then, that's how a iron condor is constructed. We look for. Let me do it again in case you are not sure. So we are going to the delta, look for the 40. This is 1090. So we sell the 1090, and then we'll buy 10 points down, 1080. We go to the put call side. Delta is 10 or below. So we don't have a 10, we have only 11. So we go for the we'll go for the 8 delta. Notice that the bid-ask spread can be wide because the market has not opened yet. So we will sell 1270. We'll buy 10 points above. I forgot to hold on to my control key. So let me come back to the 14 delta. So this is how an iron condor is formulated. Now for Thinkorswim account, you will see that the iron condor will give you the midpoint 1.87. So this means that this has a credit of $1.87. You won't get this field if you ask for midpoint. In practice, in the real life experience, you will need to go for 10 cents below at least. Sometimes I may be even going down to 15 cents below. So 187 won't be filled. You might be looking at things like 1.7, keep 10 cents down, 10 cents below the credit. So that's the credit you're asking for. And then you are going to change, because Russell 2000 is CBOE exchange. So I always turn it to CBOE exchange. So this means that Thinkorswim will send this order to CBOE. Russell 2000 is not traded in other two exchanges, so there's only CBOE. So in order to have a faster execution, I always indicate that this order goes to CBOE. Now this is something that I know by working with Thinkorswim for long, and it doesn't really matter if you say best. It's actually okay. The execution speed will be just maybe milliseconds. Sometimes milliseconds makes a lot of difference. And what we do is, you may also want to see how the trade looks like. So this is the risk graph of Russell 2000. For Thinkorswim, they don't have a modern view, they have only classical views. So you can see that the break-even point for this trade is 1271.59 and 1088.20. And the current price right now is 1188.43. So this trade might be alarmed when Russell 2000 make a 90-point move upside or make 100 points to the downside. This is called the extreme version, in the sense that we have 60 days to, in this case we have 52 days. And the reason why we do this is by going through the selection of the strike price, it allows us to create a very, very wide mouth. And when we have a very wide mouth, what will happen is that we can let the index make 10 points, 20 points. It's okay. So long as the index is not forming any form of trend, we will be fine. So that's the reason why this is actually a good trade. What is not good is you need to understand that if I were to send this order, I will have to incur $823 of risk, okay? Or your account must have $823. And your maximum profit is 177. So that is something a lot of people cannot take it, because now you're risking 823 to make 177. Now the question is that I'm not going to make 177. So let me just send this order so you can see the picture. So I send this order already. This is still a paper trading account, so it doesn't make any difference until half an hour later when the market is open. Now, what I'm going to show you is this. I'm going to show you that if you go back to the 60-day slide, you'll see that the trade will be exited if we make 10% return on the risk capital. So what it means is that if my trade has $823 of risk, if the trade can give us a profit of $82, $83, we are out. So we are not going for the whole $177 credit. We are just waiting for the P&L to be things like $82, $83, we are out. However, for the stop loss, we are saying that 15% of the risk capital, which means that 15% of $823. So it's approximately $120, not 823. So what this means is that if we don't do anything, just let the trade run on its own, our maximum exposure is $823, which is quite painful. However, if we have a controlled risk, if we manage our risk properly, our loss is $120 approximately. So this is something that you have to understand. We are not just put the trade on, waiting for the trade to make. We have to exercise our ability to exit the trade if we are wrong pretty fast too. Does it make 100% return all the time? No. I have taken losses before because the index suddenly go trend. There's nothing I can do. And this is something that we all have to live with. So if I'm going to the other one, which is the 30 days version, can I have a 30-day? The answer is, technically speaking, You have a July 4th week, which has 31 days to expiration. This is a weekly option. While I'm actually talking about standard, the 30 days, 60 days, we are not using the standard, we are not using the weekly option. So for the 30-day version, you have July, which has 24 days to go. So 24 days is still above 21 days. So technically speaking, it's still possible to get in. So the rule is we look for 14 delta. So it's 1125 and 1115. And then on the upside, we are looking for 10 delta or below. So it's 1240 and 1250 because the 1240's delta is 9. So you see, to create a trade is like that. It's very fast, 10 seconds, done, 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 done. That is the reason why most people use Think or Swim to create iron condor, because it's super fast. Okay, so this is $165 credit. You won't get it, so let me give 10 cents. Here, 10 cents to the market maker. So this is 155. Okay, so the risk here is $845. So you see that by putting this through trade, using even one contract, you have already got $1,600 locked up. Okay, and what you do is that same thing. When we talk about the trade, we need to understand one thing: how does the risk graph looks like? So obviously, I can look at the risk graph and see that for this August one, this is the risk graph we have just talked about. And if I uncheck this box and check this one, you see that this is what the 30-day version looks like. The 30 days version obviously has a narrower mouth, not the wider mouth. So if you put the both together, you'll see that one has a wider mouth, one has a narrow mouth. And hey, hang on, I have actually selected the wrong iron condor. So let me just do it again. This is the July. Okay, so that's the narrow mouth version. So you can see that the mouth is narrower for July. The thing is that because we have 30 days, compared with 60 days, we can live with a narrower mouth. Doesn't mean that we'll win all the time. We again have to manage the trade. So these two are what we have got for the purpose of the 60-day and 30 days. We have one more, which is the Ferrari version. So for Ferrari version, what will happen is that you are going for this one. So this is the 4th week of June. So you see that it has only 3 days to expiration. 3 days to expiration means that Tuesday, Wednesday, and Thursday. Okay, so this one, your job is to create the trade, which gives you $1 credit. Can I do this? Let me see. You see that for the Ferrari version, the delta for the 1210 strike is 12. So no good. I can't. I need to look for the 4 delta. For the 4 delta is very miserable. You see the credit is only like 20 odd cents. So if I were to put this in, you see that I've just got a $1 credit. Knowing that I have to cut down the midpoint by 10 cents. So this trade in ideal sense, we have got only 90 cents. We can only get 90 cents. So what I would do in the real life is I'm going to ask for $1. If it doesn't fail, that's the end of this week. It's okay. I'm not going to force the trade to be in just because I want to get in. This Ferrari version, I need to be very careful because what happened is that the trading price is 1188 as of last Friday. And what I'm telling the market is that in the next 3 days, I don't want Russell 2000 to make a 30-point move. Does it happen in real life that Russell 2000 can make 30-point move in 3 days? You bet. If Russell 2000 is being crazy, it can move 20 points in 1 day. So this is the Ferrari version, whereby if Russell 2000 does not behave in the way that I want it to behave, I can get killed very fast. You see the mouth is very, very, very narrow. We are talking about only on the upside, just 30 points. On the downside, also 30 points. This Ferrari version, our job is to get 80 cents out of $1. Okay, so essentially, these are the 3 ways of handling iron condor. And the reason why I like this, let me put this trade in first. Then I will let you know why I do this. The reason why I do this is, okay, slides, come back. The reason why I do this is because of diversification. Now, diversification can be done by way of strategies, choices. In other words, I may put some time spread, I may put some directional trade. Diversification can also mean we put the trade using different period. Now, in my own account, I have different versions of iron condor. The reason why I do this is iron condor remains my bread and butter for non-directional trading purposes. At the same time, I understand that if I follow all this rule diligently, this means regular income. The reason why I don't really use Russell 2000 as a trading instrument when I teach new students is that I'm asking students to handle an index that is a very big index. And the problem with Russell 2000 is that the problem with Russell 2000 is that the index is 1000 plus. So which means that if you are not careful enough, you can get killed very easily. So at this juncture, do I know that the ADX is trending? It is. The ADX is actually trending up, but it is still below 30. So it's not in a very strong trend. When was the last time when Russell 2000 has a 30-point trend? That is around this time. Okay, so this is 30 above. So if I were to look for trades, and when I see ADX is above 30, I won't want to get in. And here, the reason why so many people got killed by putting iron condor was the fact that Russell 2000's ADX has gone up about 30. Now, I would not ask you to do this without sufficient paper trading experience. I just want to set the scene straight. I have been trading iron condor for 8 years. And I have paper trade iron condor for 3 years before I start real life account. So which means that I have gone through very vigorous backtesting, paper trading, proved myself that this was before I placed real money. So I want you to listen to me carefully. Do not put a trade like this in real money account, because if you don't understand how you manage the account, you know these 3 trades, what's the margin that you have to put up? $2,568. The total margin is $2,568, which means that if you are not careful, these 3 trades can generate a total loss of $2,568. So you need to understand how it is managed, okay? So these are the ideas. If you want, obviously what you can do is paper trade it and see how it works. And I'm not going to force you whether you want to use real money, but understand my disclaimer. If you decide to follow the trade using real money, you need to understand that I am not responsible for your losses. Okay, so that's the bonus number 2. Bonus number 3 is double diagonals. Double diagonals is something that I am getting very much in love for last 12 months. Not a very fancy strategy. It's just that I found double diagonals very nimble because we had very high volatility environment. We also have very low volatility environment. Depends on how you set up the trade. It is actually a strategy, and the only one strategy that allows us to use it for different volatility environment, so long as our prognosis on the underlying is a non-trading one. It's not even a debit or credit trade for sure. It really depends on how the trade is opened. It can be a debit trade, it can be a credit trade. The problem with this is the risk, once again, is the difference between the strikes, less credit received if it is a credit trade, or if this is a debit trade, you have to put in the debit as well. So it depends. However, the reward, there's no fixed reward. It really much depends on the risk graph. The risk graph, obviously, for double diagonals, you can put on all options analysis. You can also use think or swim. It doesn't matter to me. How it works is that you put 2 diagonal spreads together. your prognosis on the underlying instrument is a sideways instrument. So that's the nature. How does it work? Well, what we do is that I'm going to systemize for you in the sense that this is the version that I personally doing in my account. And this version requires me to look for a few things. I have not gone to the extent of trading double diagonals on indices. The reason why I'm not doing this was I have iron condor, and sometimes I put time spread on Russell 2000, and I do trade another instrument called NDX, which is Nasdaq 100 index. I trade these two crazy animals. So I don't need double diagonals on the same indices. It's just like we are putting the same thing on different basket, no diversification. So double diagonals in my portfolio, I'm using it for stocks. And the three stocks that I'm looking at is Netflix, Google, and Amazon. It's very restrictive. I'm only looking at these three stocks. Netflix is right now about 400 plus. Google L is about 560 plus. Amazon is a stock that is about 330 plus. So double diagonals for this kind of stock, stock price works well based on my experience. And obviously, because I don't want the underlying to move, I need ADX to be below 30. So I'm putting this as a system so that you know you have rules to follow. Rather than, okay, if I feel like doing this, I will do this. So I systemize for you. You want to also understand, because we are trading stock, avoid putting the trade when the stock is announcing earnings in the next 30 days. Right now, Netflix, Google, L, and Amazon have no trading or have no earning announcement for the next 30 days, so it's all right. How we do it, we use something called weekly options. Both, we all have weekly options, and how do I do it? Again, I systemize for you. You sell a 9-day put. 9-day put will be, which means that you will open the trade tomorrow. Because if you open the trade, tomorrow, you open the trade on Wednesday, we'll have 9 days to expiration. 9 days to expiration means if you open the trade on Wednesday this week, the expiration will be next Friday. You select the delta that is between 20 and 23. And what you then do is to buy a 23-day put option, 15 points below the short put. So the spread is 15 points. You then sell a 9-day call options using 20 delta and buy a 23-day call options 15 points above the short call. Your profit target is 6% of the risk capital. Stop loss is 7% of risk capital. So you see that I even have lowered down the profit target and stop loss just to ensure a higher probability of success. In terms of risk capital, you need to understand that OA will say one thing. Your account may say another thing. Unfortunately, brokers such as Thinkorswim will charge you double margin. What this means is, if I'm going back to my Thinkorswim account, okay, let's say I'm going to put a trade on Netflix, which is now $439, okay? And you know that I've got a 9 days to, we have a 9 days. Okay, we do have a 9 days. Okay, so let's just assume that this is the one that we're looking for, 9 days to go. Technically speaking, it's not 9 days. It should be this July 1st. July 1st option cannot be 9 days. But anyway, because it's a paper account, sometimes I don't trust the days to expiration. Doesn't make sense. Because 9 days to expiration means next Friday. Okay. So what I'm doing is I'm going to look for a delta 20 to 23 for the put side. So here we have got 422.5. We have got 420. To create, sometimes you have got 23 and 20. I'm a bit risk averse. I will pick the 20. I will sell the 420. I'm going to the call side looking for a delta that is 20 or below. So 20 or below has to be 17 because the 22 is above 20. So I'm going to sell this 465. Sell 420, sell 465. And I'm going to buy options 23 days to expiration. Now, because today is not Wednesday, so technically speaking, that's not a very nice time. So just for the sake of demonstration, I'm going to buy the July option, July 3rd week expiration option. Because I've sold 420, I'm going to buy a 405 put. 420 put, sell 15 points. I've sold a 465, so I need to buy a 480 put, 15 points above. So now you see that this trade has given you a debit of $2.33. In reality, you can't get this fill. So you need to give 10 cents in order to get this fill. And again, because the price now is a closing price, it's kind of very difficult to show you a proper risk graph. My risk graph is based on the closing price is like this. Now, let me just adjust some of these things so you can see how it looks like. So the double diagonals is like two diagonals together. So this side is a call diagonal. This side is the put diagonal. The current price is 439. So I am allowing this to move. Okay? So what is happening is that the break-even point is $472 and $414, which is considered quite wide. Okay? So for Netflix to move 30 points, while possible, for Netflix to come down 30 points, yes, it's possible. But what I want the stock to do is to not move so fast, move maybe between $5 and $10 for the next week. I'll be able to get my 6%. It's very simple in that sense. Now, the problem of this trade is not the probability itself. The problem with this kind of trade is the fact that if you want to open the trade, so let's say I put this trade in the edit mode, and you see that I've got $243 debit. If I click confirm and send, you will see that my account will be deducted $3,243. Why? Because this is a 15-point spread, so the risk is $15 or $1,500. Remember I said Thinkorswim will charge double margin for both sides, so 1,005 times 2 becomes 3,000. And this is a debit trade, and the debit is $2.43. Okay, $2.43. So 1,005 plus 1,005 plus 243. This trade requires you to have 3243 in your accounts before you can send to be filled. So now I've done 4 trades already, and you will see that your account has been set aside almost $6,000 as margin, and this just 4 trades. So the question that I have for everyone is, this kind of high probability trade does require you to have a high account that has at least 10,000 or an ideal sum of 20,000. If you have like 5,000 in your account, you cannot do this trade. It's because of the nature of the trade and the instrument I'm using. So let's say that, okay, I don't want to do Russell 2000 because Russell 2000 requires such a high margin. Can I do it by way of IWM? Yes, you can. The challenge of IWM is that, yes, if you put IWM in, you have a lower margin requirement because IWM is about 10% of the Russell index. That being said, the commission size remains the same. So as a result, you may reduce your margin, or you may not have your margin take up so much. However, your commission cost can be huge. What I would then say is that no harm, no foul. If you feel that IWM is a better instrument, you don't mind paying higher commission, then you use IWM. If you think that IWM eats up a lot of your commissions, you are prepared to trade Russell 2000, then just trade one contract on Russell 2000 and gain the experience. So these are just 4 trades. Can I do this on Can I do this on Google L? Well, of course I can do it on Google L. It's the same way to construct. Google L is going to open at $562, $563 tonight. So the strike price is 550 for the put because the delta is 20 to 23, right? So this is the delta. Then I'm going to look for a delta 20 or 20 or below. So this is the one for the call. So you see that I sold 580, call 550 put. So then I'm going to the July, 15 points down. So 550 minus 15 is 535. 580 call plus 15 point is 595. So now you see that, wow, my debit is $7.30. This is huge. And remember, typically another what we call the 10 cents more. So you now know that if this is the trade, what will happen? What will happen is that your margin is 3,000 plus 740. So the margin requirement is 3740. You kind of know this already. And how does the risk graph look like? Well, this is how the risk graph looks like. Now, you need to understand one thing. Sometimes, because of the volatility skew, the trade may not look so nice. Okay, so this is something you need to live with. And you also notice that if the trade may not give you a decent thing. Unlike the Netflix one, you see that we have got 4 break-even point. The reason is that because of the volatility of Google L right now, if the stock is not moving anywhere, you will make a little bit of the loss. Google L needs to move between 574 and 581 in order to make some money. Google L needs to go down to 552 and 549 to 55, and sorry, Google L needs to go down to 549 and 552 to make some money. So when you construct a trade and you see 4 break-even points, probably Google L is not the trade that you can consider. Netflix looks better. So then I go to Amazon. Amazon is going to open 2 points down tonight as well. So let me just go down to look for the trade, because you are not going to put all trades together, right? So you just pick Netflix, Google L, and Amazon, whichever looks the best. Then you just do it. The thing is that I'm not here forcing you to choose one, forcing you to choose any one of them. Therefore I give you 3 for you to evaluate. Now the thing is that for Amazon, the delta number is not even available. Okay, the NA. So probably we need to know. We can only know this when the market is open later. So with the NA, I cannot even evaluate the trade. So the concept is just to pick the delta 20 and 23 for the put to sell, then look for delta 20 or for delta 20 option on the call to sell, and then what you do is just follow the rules. Buy bet the 23 days option 15 points down for the put, 23 days options. Buy a 23-day call option 15 points above. So digest this slide and see whether you understand. If not, feel free to ask me on the Facebook group. Okay. So tonight I've given you the 2 bonuses, and I've shown you how to place these 4 trades together. So altogether, we have got a Ferrari Iron Condor, we have got 30 days, we have got 60 days. We also have a Netflix double diagonals. Okay, so that's all for the bonuses. I hope you understand this. Adjustment for double diagonals is something that I have to talk about, because this trade being using stock as the instrument, I need you to understand one thing. Your adjustment to minimize the losses has to be fast, or else the losses can be escalated very easily. And what I mean is that if you have a double diagonals with risk of 3,000 plus, if you don't manage the trade properly, sometimes your loss can be $2,000. That is like a huge amount. So what we do is that if you haven't hit the 7% stop loss, because I'm asking for 7%, okay, of risk capital. Sometimes if the stock moves very fast, your risk capital may not be 7% only. Your stop loss might be 14%, 15%. So you may then say, but I don't want to lose 15%. I'm prepared to lose 7%. So for those people who refuse to admit losses, and you want to make some adjustment, that's the adjustment slide for you. I'm not here telling you that if you hit 15%, you have to get out. I think you should. It's just that in real life, some of us will be in denial mode, saying that why not we give the stock some chances to breathe. Okay, so then look at adjustment. So your adjustment point is when the delta of the short put, which is originally 20 and 23, is now 35, you've got to adjust. When the short call originally delta is 20, is now 35, you've got to adjust. Your only thing to do is to buy a 30-day put or 30-day call. Your job is to cut the delta by 1/3. So from 35, you cut the delta by 1/3. What does it mean? You need to look for a put with delta around 10, 12, so that 35 becomes 23, 22. Your call, if your delta for the call is 35, you need to look for a call with delta 11 or delta 12, so that your delta will be cut by 1/3. Not cut to 1/3, cut by 1/3. How does it work? Well, it's very difficult to show you examples, so I'm going to only give it as a guideline. If you are not sure, feel free to discuss in Facebook group. I'm happy to talk about this. But my point is that if you hit the 7% risk capital, you just get out. Okay? And lower it down to 7%, which means that your 6% of risk capital as profit target should be quite easy to meet, unless the stock decides to make a fast move that will kill the trade completely. Okay, so this is double diagonals. I use it for Netflix, Google, and Amazon. You may want to see whether this is for you. So I hope that you enjoy these bonuses. Now, with about half an hour to go, I want to finish off the session by looking at a couple of things. I also want to do something about the what I've said yesterday and this morning on the Facebook, because I said in last session, this is July expiration day 1. Okay, we are now into July expiration. Tonight, the market will be open in July expiration cycle. I said, well, last week we talked about long call diagonal spread, and I said, well, I'm going to only look for the opportunities from today onwards. So I've evaluated a few trades, and what I've seen is that I posted all the findings in the Facebook group, so you need to go to the Facebook group and check. And I've also explained to you, if the trade setup is good, I will place the order. If the setup is no good because the chart is ugly, I will wait for the chart to give me the better picture before I get in. I have plenty of time, so I'm not in a hurry to get this trade filled. My job is I want the stock to give me some nice idea. So the couple of stocks that I'm looking at, they are all IBD 50 top 2, top 3, top 4, and top 5. So one of the top is the TRN, Trinity. You see that it's hovering around 20-day moving average. You may not like the bar on Friday because Friday's bar is an inside bar. I want to see some strength. I want to see it bounce off 20-day moving average. That is what I've seen. THRM, nice. Okay, THRM is nice. It's still trading above the 20-day moving average. Typically, I like this type of sell when the stock comes down and bounce off on the 20-day moving average. That's the very nice day to go in. Okay, that's the very nice day to go in. That's me. I don't know about you. But if the stop price is here and your 20-day moving average is way below, then you understand that, okay, the market has just opened. My paper trade account just ring the bell. So what will happen is that if the stop price is quite high, like SN is the one that I say I don't want, because SN is trading this way, which is quite above the 20-day moving average. I want the stock to come down and test the 20 moving average before I place the long call diagonal spread. The other one is CAR. CAR, you can see that it is also bouncing off the 20-day moving average and moving up. So you can see that I'm waiting for the stock to give me some action, hovering around 20-day moving average. If it's not moving, it's fine. If it is moving up, even better. But if it's moving down, then we honor our stop loss. So these are the strategies that this is the strategy that I put whenever we begin a new expiration cycle. So for further detail, you can actually go to the Facebook group account. I posted all the things early this morning and also last night. Let me see whether I can show you here. If not, then there is another. Okay, it's up. Okay, seems that it's up. Okay, so this is the one. You can see that I've got the analysis, the various charts. Okay, so I've shown you the analysis already. So I want you to go back and read this. Okay, they are all self-explanatory. Okay, so I've done the analysis for you as promised. Okay. All right, so this is what I've done for the long call diagonal spread. Okay, so now I'm going back to wrap up the course. In the next half an hour, I want to really go through this. This is especially beneficial to batch number 2 because if you have not heard this before, my mentor ever said that it is possible to achieve a goal of 5% per month. It sounds crazy, 5% a month, using a $30,000 options portfolio. It's possible. $30,000 account, 5% per month. That means you don't go for compounding. You just look for simple compounding. Not even compounding. You just look at 5% of 30,000 is $1,500 a month. The question then is, how do you make $1,500 a month? So portfolio allocation, if you really have 30,000, wow, I have a trade field just now. What is the trade field? So now you can see okay, sorry, the Netflix was filled $2.41. You see, this is the paper trading. So originally I asked for $2.43, it's $2.41. Netflix is down $3 now. So whenever this is the case, $2.41, and if you put this on the paper platform, you remember Think or Swim asked for double margin. So the risk for this is 1,005 plus 241 cents. 1,005 plus 241 cents. So my 7%, if I have got a calculator here, let me just do a very quick sum. Hold on. Okay, my calculator is here. I want to compute my 7%, so let me just do it very quickly. 1541. Sorry, it's not 1541, 1741, because it's 1,005 plus 241, and then multiply by 0.07, 7%. So which means that it's 121.87. So which means that, okay, let me do it again. 1741 times 1.07. So that's the price I have to sell. Okay, how do I sell it then? To sell it, I will just place the order. I place the order. Sorry, wrong. I just need to place the opposite order. 121. So 121 is 362. I just need to sell this for 362, 3.62, and then GTC order, and then send. That's it. Because the 7% is 121, so I'm placing the trade and asking for $362 of credit, and then we should be able to clear the 7%. So I'm now doing it live to show you how to handle it. The market obviously is down tonight, and okay, another trade was filled. Now this is all the funny thing that you see in the real life action. So this is the July. This is the let me see. This is the Russell July one. For July 1, you have $1.55 filled. Okay. So what I would do is that I will buy back this one. Let me see, 155. I I need 80. I want to make $80 because I remember I say I want $10 of my risk capital as the profit. If 155, so my risk will be $845. So 10% of 845 is 84.5. So 84.5, 155 minus 8845 would be 65 cents. So if this trade can be sold for, can be bought back for 65 cents, I would be able to make that 85 cents. Okay, so the map, I'm actually working out the map using mental. I don't have calculator with me. Essentially, what I've done is if I'm selling the spread for 155, my risk will be 845. Okay, because it is a 10-point iron condor, risk will be $8.45. $8.45, which means my 10% will be around 85 cents. For 85 cents, 155 minus 85 cents is 70. It's actually 70 cents. Okay, so I need to submit the trade by buying back the iron condor for 70 cents. If I sell it for 155, buy back for 70, I will make the 85 cents. So I just need to buy back the iron condor for 70 cents. So I will be able to make the 85 cents credit. So this is what will happen in real life. Okay, wow, Netflix is down quite fast. Okay, interesting. Never mind. So the other trades the other two trades are still being filled, not filled yet. You see the Ferrari iron condor, I'm asking for $1, but the midpoint is only 90 cents plus. So that means I can't. And for Russell 2000, 177, you see the price now is 1.725. So I won't be filled because the market price is below the credit I'm asking for. So I've got to wait. Okay, so when will I look at this again? Probably after the first hour, I will then evaluate the trade. If there's nothing I can do, I'll just leave this order for the whole night. And tomorrow, I'm going through the same process, put this trade again, because remember, these are the day orders. So if they are not being filled on that day, they will be cancelled. So the next day, on Tuesday, I will look for the setup again and just place the trade one more time. If let's say the August one cannot be filled, then I still have I have no chance to fill already. It's too late. The Ferrari one is, if I don't get it filled tonight, I won't even put it in. Okay, so these are the iron condor management. So I'm showing you sort of like the real life example. Okay, although it's a paper trade account. And I want to go back to the portfolio goal. The reason why I want to talk about portfolio goal is how you make your 1,005. You are talking about using 7,005 as spare cash. You are using 75% of the $30,000 account to generate the 5% per month. Why do I have this ratio? Is because you want 25% of a $30,000 account to be kept for what we call the looking for new opportunities. Because you don't want to use up all your $30,000 account. Your objective is just $1,005 a month. The question you have to ask is, how do I get $1,005 a month? Okay, so the trading strategies that we have talked in this whole class, in the whole 5 modules, in the money call, if you don't buy stock, out of the money call as speculative trade, straddles for pre-earnings, post-earning, long time spread, non-butterfly, that was session 4. Iron condor have got 4 versions altogether. One is the 24, 40-hour trade. You have seen the Ferrari, you have seen the 30-day, you have seen the 60-day. You have seen double diagonals. What I want you to do is you start with 2 or 3 strategies you like. You feel confident, you feel that it suits you, and practice vigorously backtest and forward test. Prove yourself 6 months at least by forward testing it, making sure that you really mix money before you trade live. I always tell people, if you don't trade live, you won't learn. Because backtesting, what will happen is that you make a lot of money. Backtesting, many people make money using backtesting, but when they trade live, they don't make. The reason is that the forward testing psychology and the backtesting psychologies are completely different. But that being said, forward testing, I'm not asking you to trade live using real money. You can actually use paper money if you like. So although 1,500 a month is possible, it doesn't mean you must start also making 1,500 a month at the beginning. You may want to say, okay, take one step at a time. First month, 1%. Second month, 1% for 6 months. So you show that you make 1% per month for 6 months. Then you slowly make it to 3%. Eventually, you make it to 5%. So when I say 5%, it is still quite subjective in the sense that how many of you agree that you can make 5% instantly per month? I can't. I didn't have that experience too. I started telling myself, okay, let's make a 1% a month. Okay, I can make 1% a month. Let's make 3%. Let's slowly progress it to the 5%. Okay, so that's something you need to think about it. And calendar trading, remember last week I said I have got a calendar for you to see how I systemize the whole business. I'm not talking about calendar spread. This is the reason why I said a calendar is important. I actually print out a calendar and stick it on my wall, not here in Hong Kong, but I have got a calendar on my desk in Singapore so that I know exactly what I'm going to do every day. So for example, some strategies are based on time. Time spread, butterfly, iron condor, they are all based on timing. So I will jot down my diary or calendar to remind me when I'll place the trade. Some trades are based on earning announcement. So I need to jot down the earning announcement for the stocks that I'm looking at, and then making sure that I take action before or after the earning announcement, depends on what strategies I'm using. For directional trading strategy, I kind of look for them not every night because I have a very busy schedule. Where possible, I'll make an effort to look at it every night. If it's not, then I say, okay, Monday, Wednesday, Friday at a minimum. So I am able to keep track of what's going on in the market. So this is just a calendar you can see. It's just sort of like tell us that what am I looking for the whole month of March. You stick it on the wall, you know exactly what you are looking for each day, except for Saturday and Saturday and Sunday, which you can use it for other reasons. So you see that on 4th of March, 11th of March, 27th of March, I have nothing to do, even on 30th of March. However, for directional trading, looking for opportunities every Monday, every Wednesday, every Friday. Okay, let me just roll it up. You can see it better. So I've got Chihu in March this year. There's a one-day straddle. Then I have double diagonals. And then, for example, I can start time spread on every Wednesday. So again, the question that I have for you is that think about all these strategies we discussed in these 5 sessions. Decide for yourself which is the one that you like the most, and then start putting them up on the calendar. You can go to calendarlabs.com, L-A-B-S, L-A-B-S, Los Angeles boy, okay, L-A-B-S. And then you can print out a calendar, make it real, so that you know which day you need to do something, which day you can have a rest. You don't need to do trading every night on a free flow basis. Okay, systemize it. That's how you can make consistent money in this business. Okay. And then the next thing that I talk about is trading psychology. I'm specializing in psychology quite a lot. So psychology is something that's very important. Some of you know that my mentor ever said that 80% of the profits come from proper psychology, which is the sound money management rule and a positive mindset. Every one of us go to, for example, in my previous teaching experience, optionetrics, you notice that lots of people who sign up for a 2-day class, not everyone can continue. The funny thing about this is that I am still the only one from my 2004 April's batch, our first batch of optioneering students. I'm still the only one very active in this business. The rest have disappeared. So you see that in my batch, we have 200 people. One of 200 is still talking about trading options. The rest have given up. Why? Because you and I can learn the same trading system. You and I can learn from the same master. But one makes money, the other doesn't. There must be a difference between most people and the minority. It's all about trading psychology. It's all about money management. The two books that I always recommend people to pick up and read. Good news is that you can actually search internet. I'm not asking you to buy it, but if you want to buy a book and a feeling, kinesthetic feeling of reading a book, go buy these books. Trading in the Zone, which is this one by Mark Douglas, and also The Psychology of Trading by Dr. Brett Steenbarger. Okay, so these two books are must read, in my opinion, for trading psychology. And what it teaches us would be about the emotions that we'll go through as a trader, and the very fact about when we have emotions in the market, we become another person completely. The last sentence said people lose money in the market because a person who places the trade very often is not the same person who manages and closes the trade. So you see, we have multiple identities. We can be very, very sane, very clear with what we are doing before the market opens. Just now, when you look at what I've done with my accounts, I was working very fast with all the credit, debit, all these things, and I actually make some mistakes. The reason is that when I'm in the market, I'm a different person too. So that's why when I'm talking to you, I let the trade run. That's the whole point. Because if you are looking at your account and make trading decision, you can go off track very easily. Okay, so we can perform endless research, learn every indicator, receive the best mentoring, and still fall short of our trading goal, because we have this thing called emotional temperature. Emotional temperature is that when we are in a trade, we are a different person. And how it works is that if we have a trade plan, if we are clear with our guideline, that will help us mitigate the emotional temperature. That's why we said we need to have trade plan. We need to be clear with our objectives, systemize the whole business by calendar. You have to go through all these things in order to have consistent income. Holy Grail crystal ball ability to predict the future are good to know, but they won't happen in real life. You need to understand that taking losses is natural in this part of business. Everyone will have losses. I took losses. I can tell you last few weeks, because I didn't really pay attention to my account, I have a series of losses too. So what does it mean? Well, I also have losses. Worse still, I have 5 consecutive losses each day. Then how? Am I going to give up easily? Well, that's the thing. As long as I follow my rules, the rule says in the end it becomes a losing trade, so be it. You need to understand this. 4 aspects of trading psychology: discipline, patience, confidence, and money management. And this is the part which I like a lot, because every time when I'm teaching this and I'm revising this aspect, these few slides, it reminds me that I'm still a human being. The goal of imperfection in trading world is likely to lead to greater profits rather than pursuing perfection, because everyone wants to be perfect. But the thing is that if you are looking for perfection, you're looking for the Holy Grail. So emotion is our #1 enemy in trading business. So we do need to reframe our mind constantly, positively, if we lose money especially. So the thing is that if we go through our mind, the mind will say, okay, if I have got a losing trade, what does it mean to me? So George Soros ever says it's not about being right or wrong. It's about how much money you can make when you're right and how much you don't lose when you are wrong. So the ability of looking at losses, how we interpret losses, is important. Patience. I've stressed enough in this class that channel breakout trade does not come often. You do need to be very patient. If it happens, it happens. And what if it happens and you don't take action? Well, so be it. You then learn the lesson and understand that if next time something happens similarly, what would you do otherwise? Are you going to be more active? Are you going to still doing the same thing? Albert Einstein ever says that it's insane if you keep on doing something again and again, expecting a totally different result. Okay, so you do have to change your strategy if it's not working for you. And most of us have a tendency to stare at the screen, hoping that the market will do us a favor. You know this is not true. Especially, I still have this annual event called Pressing the Wrong Button. What it means is that if I want to buy something, I can press the sell button. It happens to me still once a year. It is an annual event. So far, touch wood, in this year, I have not pressed the wrong button yet. But who knows, in the second half of the year, it might happen. Funny things will happen. So it's not about one trade, it's about the entire trading business. Focus on the big picture. Be confident, believe in yourself that the system, the things that I've talked about will work. It's all about how you make it happen. A lot of people actually went for classes and they say, wow, the mentor sucks, the training program sucks, the teaching strategy, the training strategy sucks. Then I always ask them, have you given yourself an effort to make it happen for you? In my world, I always tell my students, do not expect I make money for you. Do not expect the course will make money for you. I have seen students who decide not to trade the things that I've been teaching. Reason is that they found that the teaching is the systems are not for them. Okay, so I have one person from batch 1 who said that I cannot trade your systems because they are not for me, which is okay. At least he had paid a small fee, small tuition to find out this is not the cup of tea. I have another student who told me that it makes lots of money for him using the strategies I've taught. Then I will ask, I'm teaching the same thing to a group of people. How come some say no, some say yes, some say make a lot of money, some are still learning? It's all about whether we are confident in what we are doing. Okay? And the thing is that we are here finding ways to make our system profitable. You have to believe that it works for you. If you don't believe in what you are doing, then the things will work. That's very important. Okay? And look for excuses not to trade is something that I always tell my students to look for. In other words, if the market is not giving you things that you want, if the market is not giving you the opportunities you have been wanting, then you just say, okay, never mind. Today is another good day of not trading. Always look for excuses not to trade because quality is much better than quantity. Jim Rogers' money on the sidelines is better than money in someone else's pocket. That's said by Jim Rogers. What are the kinds of fears we have? Uncertainty, chaos, losses, which is very important, and being wrong. Because the Asian culture has taught us one thing, we must be right, so we cannot be wrong. Unfortunately, in trading, we must understand, we must also accept that we can be wrong. But how many of us actually can accept that? Okay, so all these things are no hope, no fear, no hope, no fear, no greed. Money management rule is always ask yourself what's the position sizing, what is the capital that you want to put in a trade. Do you have a trade plan? Do you have stop loss? Do you have profit target? And once we have got all this in, and now, for example, my trades are filled. What can I do? I'll just let the trade do whatever it's supposed to do. I cannot do anything. I will not say, oh, Netflix, I'm making some money. Yes, good. Oh, yeah, but my Russell 2000 is losing money. How? I can stare at the screen and say, oh no, this is not what I want. Let me hope that the trade will turn around. But you know the market will just do whatever he's doing and he won't care what you're saying to them. I can say, okay, let me see. While Netflix is down only 57 cents. Okay, let's go up. And then cheer for Netflix. You know, in real life, you won't move. Okay? No matter how you stare at the screen, it won't be moving in your favor. Because it is doing to do what it's thinking, what it's supposed to do. So why do you need to stare at the screen? Go watch TV, go to read another book, go sleep. Much better than staring at the screen. Reframing. What if you have losses? What do you tell yourself? Losses will happen. It is a matter of time. Why would you not be able to accept losses? Like I said, in the Asian culture, we have been trained our mind to be right. We cannot accept to be wrong. That's the problem. So here are some of the things that I said. It's not the end of the world. It's no big deal. Reframe. I'm stopped out. Good. That means I will still have capital for my next trade. Good. That means I have followed my rules and trade plan and exit exit at the time when I have to. Have you talked to yourself this way when you have losses? Or have you talked to yourself the other way? Shit, F, I lost money. How can? Okay, so they will have another losing trade. Just catch yourself what you have said to yourself. Then you notice that if you blame the world, refrain. And then you start noticing some changes. Trust me, because I've been to that stage. Okay? So this is a very important slide. A loss never bothers me after I take it. I forget it overnight. But being wrong by not taking the loss, that is what does damage the pocketbook and to the soul. Just Livermore says. Okay? When you put the trade, the market will do whatever it is. There's nothing you can do. If it turns out to be a loss, so be it. You cannot do anything. But if you don't take a loss because the trade system asks you to do it, then this is a sin. That is wrong. Okay? So money management. These are the 10 commandments. You may want to print them out, stick it on the wall if you like. You have copyright of printing out. You can have you have also copyright to share with your loved ones. But do me a favor not to teach other people. Okay, let me do that. Let me do the teaching. I have the copyright to share with your loved ones. Rule number 1, invest only the amount you can afford losing. Rule number 2, avoid high leverage because we don't need this based on our trading methodology. What do I mean by leverage in the world of options trading? Option is already a leverage. So let's say if you have bought SAVE, for example, SAVE, S-A-V-E, the stock, you bought 200 stocks. Now you know you can buy 2 contracts. But you still have spare cash. What do? You tell yourself, oh, I can buy 20 contracts. No, you buy 2. You avoid high leverage because you don't need that. Option itself is already a leverage. Okay? Capital preservation is always important. Always look at what's wrong, what is the risk if you're wrong, not how much profit you can make. Always. Always put a stop loss. Always have reasons to get out. No excuse on that. You'll notice that I'm not so particular to the reasons to enter, but I'm very picky to the reasons of getting out. Your effective risk on each trade should be 5% or below. When I say effective risk, means the managed risk. For example, the margin that I put just now was about $6,000. About $6,000. This is called the risk capital. No, this is not risk capital. This, in fact, for the double diagonals, it is only 1,005. Okay, so when we say the risk capital, I'm actually looking at things called effective risk. Not necessarily the debit you put in, not necessarily means the amount of margin you put in. It can also mean your effective risk. So for example, if I'm wrong, if I say, okay, my loss is $850 just now. But what is my effective risk? I say if I hit the 20%, I'm out. Sorry for iron condor, if I hit the 15%, I'm out. The 15% is effective risk. So there's a difference between effective risk and the maximum risk. 6 is have a profit target before initiating a new position. If you have a directional trading strategy, make sure you move your stop loss whenever it's possible. For non-directional strategy, keep in mind the stop loss. Okay, you have a stop loss, and when the stop loss is triggered, you need to act fast. Because for non-directional trading, you know that we have a very high probability plus high risk. If you don't act fast, you can make you can incur higher losses. Don't revenge, no double down. Never add a position on a losing trade. You don't need to trade every day. Look for quality setup. It's always the key to success. Practice defensive trading. Always look for excuses not to trade. Finally, if you make a lot of money, remember one thing, your broker may not be safe. Okay, even though TOS, Think or Swim, Option Express are protected by Monetary Authority of Singapore, your profits are with them. So do understand that sometimes when you need to withdraw some money. So do not put like millions of dollars with them. They might be safe, but who can tell? Okay, so the last 2 slides I have for you is trader who just want to make money without understanding what processes are involved are better off investing in a fund or gambling. And by trading emotionless as possible with the system investing plan, we eliminate the greatest threat to our trading survival. Structure imposes needed order in trading, which is pulling profits from ordered chaos. Opportunity identified in chaos. So in all I'm saying is that you need to have a system. You need to know exactly what you're doing. You need to have a trading plan. You need to talk to yourself, believe in yourself, be confident in yourself, be patient with the setup. So you see that there are a whole lot of things that you need to watch out for. It's not about learning, okay, today I'm going to teach you this strategy, next week I'm going to teach you another strategy. Strategy is only like 20% of the trading success. There's 80% of all these things. Have you considered this? Final slides. Even though with all knowledge and the perfect system, you may not be able to overcome trading emotion. So when you put a trade, every trade will bound to have a risk of losing. But successful trader like calculated risk. Trading is like baseball player batting average. You don't need to make money. You don't need to be 100% right all the time. Directional trading, for example, if you have a if your hitting rate of about 30–40%, but you have a very solid money management rule, you can make money. Trust me, directional trading, especially 30–40%, you can make money. But for non-directional trading, of course, of the high probability, you do need a higher chance. You need to have more winning trade than not. So again, so this last part is directional trading. Is meant for directional trading. The last slide for this course, which is also the last slide for tonight, is I do plan to start batch 3 in quarter 4. In the next quarter 3, I'll be very busy with my teaching and other stuff, so I won't be holding a batch 3 class. But I do plan to start batch 3 in quarter 4. Have not confirmed yet. So if you want to join me, so just like some of the batch 1 students who are here watching recording or joining me live, what I'm only asking for is $1 US as a reattendance fee. The reason why I impose $1 US is this is something I found out in Asian culture. Asian like free stuff, but they don't appreciate free things. So therefore, I'm charging US $1 just to ask people to show commitment to be here because there is pain. I do have about 70% of the people who didn't pay me $1 in batch 1. I have not heard of them anymore. Well, this is the life. So I do understand those who pay $1, they are still talking to me. Those who don't pay $1, I know that they have moved on to something else. So as a mentor, what I can say is that those who continue will succeed. Those who don't continue with me, I wish them success somewhere else. I'm not saying that they will fail. It's just that they may not find what I'm teaching suitable for them. But that's the life. And once you are in the Facebook group, you'll be there forever unless you decide to delete yourself or unless you decide to kick yourself out. I mean, I won't kick you out. You'll be there forever. The more you ask, the more you learn. So please ask questions. It's very interesting. After batch 1, the traffic suddenly went down, very quiet. Nobody talked about anything. Then when I start batch 2, you see recently the traffic has gone up again. Then I wonder after tonight what will happen. So I do need you guys to continue asking questions. And notice that even though I may not be the one answering the question, there could be inputs from other people. Work as a team. Hope that you will be able to succeed. Okay, so with that, that's the last slide, and I have now is now 10:05. So let me take off the screen mode, sharing mode, and understand that what you have got here is hello, and okay, good. So now you can feel free to unmute yourself if you like, and if you have questions, you can ask.
Hi, Jack.
Yep.
This is Andrew. Thank you for the lecture, and thank you for your effort to answer my stupid question.
Hey, please, it's not stupid question. It's just that I just want to make sure that all questions have a reasons. I need to understand the reason. That's me. That's all my problem. No problem.
Appreciate your effort. Yeah.
Yeah.
What about
Okay.
the final few slides? You're talking about perfection, right? That perfection is likely to make you lose more money or something like that.
Perfection will not make you lose money. Perfection may lead to procrastination. Perfection means that you are looking for the proper setup, and by that time you may not have entered into any trade, and the trade may have gone already. So
That's why I'm wondering. I thought we have to be following the rules strictly. That's why we have to make sure all the signs are there. Then we can enter the trade.
the thing is that if the system says I have got 1, 2, 3, 4 guidelines, and you then say, okay, I'm not very confident that by going for these 4 guidelines, I will be good for this setup. So I start looking for the 5th, the 6th, the 7th to make me feel more comfortable. That's what we call looking for perfection. Because you can never look for a perfect setup. That's the problem. So the guidelines are there. As long as you check the boxes, the 4 guidelines, for example, you say, okay, these are the 4 guidelines, 1, 2, 3, 4, I'm good to go. You have to go. You can't wait for the 5th one, the 6th one, even especially they are not part of the guidelines.
Oh, I see.
Yeah. So perfection means that you are not confident in what you have been doing, and therefore you constantly look for further information to validate the setup. And by making a lot of validation, taking too much time for the validation, you may procrastinate.
Definitely too much of a safety factor, and then
Yeah, so this is the life. You cannot look for all risks to be covered before you take
no
action.
100%. Definitely.
No, you have to understand trading cannot be 100% correct. So once you understand this, then you should not be looking for perfect setup because there isn't any perfect setup.
Yeah, agree.
Yeah.
Yeah. Actually, in the earlier lecture, you mentioned that okay, our risk is $1,000. Let's say.
That is
So
for the system number. That's for the directional trading system.
yeah. So then we have to make sure that the number of contract and the and the equivalent share,
Yeah.
the total cost of the share must not exceed the $1,000, right?
No,
Because in
no,
case
no, no.
the option is exercised,
The risk per
then
share does not exceed 1,000, not the cost of the share.
the risk per share.
Yes, the risk per share, not the cost of the shares. The cost of the share can be above 1,000.
Yeah.
Because you
What I
just
mean
say
is,
cost per share.
no, sorry.
You
Let's
say
say our total risk is $1,000. Let's say our
yes.
total risk is $1,000.
Yeah.
So let's say based on our risk analysis, let's say we can buy 300 share.
Okay.
300 share.
Mm-hmm.
Let's say we can buy 300 share, but then when we come to option, well, one option is 100 share, right?
Yep.
One option 100 share, then let's say the total cost of the option is less than 1,000.
Mm-hmm.
We still got to stick to the value of the total share that we are supposed to buy based on the risk analysis.
No, you don't go back to the value of the shares. You have already done the analysis and say that you can buy 300 shares. So instead of buying 300 shares, you decided to buy 3 contracts.
Yeah.
Then that's it. You focus on the contracts, options contract. You don't go back to the shares anymore.
Yeah. That's because even though the value of the option is much less than 1,000, we cannot go more than 300 share, right?
Because in the first place, you're talking about 300 shares.
Yeah.
So 300 shares is translated into 3 options contract.
Yeah.
So even though you have spent less than 1,000, that's point number 7 if I'm not wrong. You don't over leverage. You don't have because option is already a leverage. And you say, okay, since I spend less than 1,000, I can buy more contracts. No, 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 no. You just stick to 3 contracts.
Yeah.
Because you can only buy 300 shares in the first place. So 300 shares equals 3 contracts. End of story.
That's in case the option got exercised, right?
No, it's not that. You just understand that one contract is 100 shares. So if you buy 300 shares, you can consider buying 3 contracts otherwise. That's it. You will not put another rule there and complicate the story. 300 shares, 3 contracts. 400 shares, 4 contracts. 500 shares, 5 contracts. 89 shares, no contract.
So this rule apply to all sort of option strategy.
No, this is just
Only
purely
direction.
for session 2. Yes.
Why is it so? Why for other butterfly all these?
Why? Because one is options, one is directional trading strategy, the other is non-directional trading strategy. Each of them has a different risk profile.
Oh, I see.
So you cannot, that's why I said, for the rules for CB trade, these are the rules, these are the steps. You are not going to put these rules to another trading system or another trading strategy. You will mix up the whole thing. Each strategy, I have got the entry guidelines, ways to go in, ways to get out, how you make money out of the trade if it's a profit, and how do you take the loss if it is a losing trade. So each strategy has its own risk profile. If you put the risk profile to different strategy, I mean the same risk profile to different strategy, you'll mess up the whole thing. No, you can't do that.
Definitely.
So you need to, what I would tell you is that either you copy down the list or you print out all the slides, post them on the walls so that you always look at the guidelines for, okay, tonight I'm looking for directional trade, I'm looking for CB, so these are my guidelines. Have I fulfilled 1, 2, 3, 4? Done. Tonight I'm also looking for calendar spread, so these are the steps. Have I fulfilled 1, 2, 3, 4? You're looking at 2 different pieces of paper and stick it on the wall. So you can have a visual cue. Okay, these are my rules. So that I don't remember, I actually see them.
Otherwise you flip, it's very difficult to find.
Yeah, so you print out the guidelines, stick it on the wall, so that when you look for setup, you can see the rules. You don't remember the rules, because when you remember the rules, especially when you're not clear of the rules, you can remember wrong things. But if you see this, you cannot be wrong. Yeah, so you print all the rules just like the calendar. Even though it's something already in my mind, I can see it visually so that I would not make mistake. Unless, like, because now I'm in Hong Kong, I have no choice. My calendar is in Singapore. I cannot see. So that is called exception. The general rule is that you do see the guidelines.
But generally, I think we should start from the simple core option, then slowly we progress to all the more complicated one.
For you, I can't speak for the others. There are people in this group who feel that the non-directional strategy is easier. It's just that in Singapore culture, most of us learn directional trading first. So, and most of us actually started off trading stocks first. So as a result, when retail traders who are very familiar with directional trading strategy migrate to options, they always find that directional trading strategy in options easier. I started off without any stock trading background. So for me, when I pick up non-directional strategy, it is easier for me because I don't have any bias. So I won't say that simple directional strategy is always simple for everyone because it doesn't apply to me.
I see.
Okay, so Colin has a question. Let me deal with this first. When you get a stop signal, do you avoid amateur hour or do you try to wait and get a more favorable price? Very good question, Colin. If you have a trigger, you should get out consistently. Now, when I come to this point about, okay, should I exit the trade at 9:30 or 10:30? I always said to your way. but you do it consistently. So if your rule is amateur hour, you have to exit regardless of what happened, amateur hour. But you have to say to yourself that every single trade that I'm going to take losses, I'll exit at amateur hours. Because it's not about amateur hour will be better than the after amateur hour. There's no one better than the other. The key point is that consistency will help you mitigate your loss overall. So therefore, my question to you, Colin, is you got to decide. Me, 10:30. Me, I avoid amateur hour. How do I do this? I don't even watch the market for the first hour. That's me. I do have to take the risk. The risk is that what if my stop loss is widened during the first hour? I have no control. But I've been doing this very consistently. Some of the people will tell you, Colin, you should exit the trade whenever the market is open. It works for them. It doesn't work for me. Why? Because I have been very consistent, looking at only my accounts at 10:30. So now while I'm talking to you, am I looking at the account? I'm not looking at the account. Do I have make money? I don't know. Have I taken losses? I also don't know. So that's me. I've trained myself over the years not to look for the first hour's action. So hope that you answer your question, Colin. No problem. Okay. So Andrew, any more question?
Coming back to this directional and non-directional, based on your experience, I think most of the time the market or the share are non-directional. They're in the ranging most of the time 70-80%. Therefore, if we concentrate on non-directional, actually the opportunity of trading is better, right?
The thing is that there are stock will make $40 in 2 days. You make $4,000 in 2 days. Non-directional trading strategy, 10% a month, 5% a week, which may translate into only $100 or $200. So some people said, I like to make $4,000 in 2 days, not $100 a month. So which is better? So I cannot say. I also do not have statistics to prove that the market is non-trending 80% or 70% of the time. Because when I say market, which market are you talking about? Or which stock are you talking about? Unless we have seen statistics, I refrain from saying very generic term that 80% of the market doesn't trend. The market has been trending since 2013. Hello, what are these guys talking about? So I stopped generalizing anymore unless somebody can prove to me the numbers. Otherwise, I just look at the market. I just look at the stock I'm trading. I just look at the system and decide for myself. Am I doing both now? Yes, I do. Am I preferring one to the other? Not really. It depends on what system I'm using.
I see. I think it's better to have a balanced strategy, that means a mix of directional and non-directional. I think that's
it can be one thing, or you can have the whole portfolio doing directional trading. In other words, you are just doing CB or trend analysis. You can ignore the rest. It's up to you. It's always something for somebody. So my point to you is that, and for this I'm speaking to the whole group, is even though I'm telling you I prefer non-directional trading, it doesn't mean anything to you because you and I have different preference. But my job as a mentor, as a coach, is I need to tell you everything. I need to show you that these are the strategies that can be considered. And in order to do them, give you the experience, I have to force myself to trade all these things so that I'm not talking about by the book. What I have shown you in classes, all the classes are the things that I have trained myself to do. Some are not my very preferred strategies. Some are my very preferred strategy. But I hate to give students a textbook experience because you can also teach people textbook. What's the point if I don't show you the real life experience?
Also, another problem is if you have too many strategies, also need to spend a lot of time, whether we can afford that amount
Yes,
of time.
so that's why if you are not involved in the teaching like me, just pick 2 strategies, 3 strategies, that's it. I unfortunately am stuck in this position in training, so I cannot just say, okay, let's all practice iron condor. Let's forget other strategy. I can't. Otherwise, I'm not qualified in teaching options. So my instructor role requires me to expand, to stretch myself to a higher level, which is not necessary for student traders, for trainers or instructor.
I think for
No choice.
part-time trader, I think we can't actually focus on too many strategy. Maybe
No, you shouldn't.
three
If
maximum.
I'm not teaching, I won't be doing all strategies too.
Yeah. Unless we
choice.
are full-time trader, then we get more strategy, more
No,
time
it's
to
still not
spend.
true. It's still not true, in my opinion. You can trade full time. You can practice one strategy. That's it.
Oh.
All strategy makes money. If you find the one you love the most, if you are the best in that particular strategy, you make money. So it doesn't really matter whether you're full time or part time. I never subscribed to the concept of full time in the first place because but after this course, as soon as I got the video upload to the website, I go to sleep already. Am I trading full time? No,
Full time is don't have other job, just do trading.
but the market opens from 9:30 to 4 a.m. Are you going to sleep the whole day?
Oh.
Cannot find something else to do, please.
Of course, find something else to do.
So then
not have a full-time job, not have a full-time job.
Have multiple assignments.
Yeah.
We don't call full-time part-time because nowadays lots of people talk about jobs. And I'm saying to people that most people focus on jobs and want to get employed. Hello, you can actually start your own business. You can actually do your own things, be independent contractor in multiple assignments. You don't need to really be employed.
Yeah, right.
So my point is that you can find something else to do that is meaningful, and trading is just one of the many businesses you have. That's it. Why focus on full-time? Because the story is that once you hold on to the concept of full-time, part-time, there's only one full-time job. You cannot have two full-time jobs, right?
Yeah.
So when trading is a full-time job, the other is part-time, so you forever have only two jobs. One is full-time, one is part-time. Then you get stuck. Doesn't make sense. Again, your mind will tell you, if you have only two jobs, your mind will program it in such a way that you only have two jobs.
Yeah.
Our mind is very powerful, very good at programming.
It's true.
Yeah. So I'll ask that if you have if daytime, if in daytime you have time, you have free time, you do something else.
Sure.
Trading should just be a very small part of your business. We can make a lot of money. Yes, it is a small part. Okay.
But just of the example you're saying, 5% of 30,000 investment, this is equal to 1,500 a month, which is not very much for a person to make survive, make a living, right? To have 1,500 a month.
Yeah, that's right. Because you have 30,000 capital.
So that means to say that
10,000, you need to have $1 million account.
So that means to say that if you want to earn more, we have to put in more investment, put in more trade.
That is the golden formula.
I see.
That is the golden formula. You talk to every single instructor instructor will tell you the same thing. You need to have $1 million in your account in order to make 5 digits a month.
But then it will be a very high risk to put 1 million in there.
Yeah, that is the reason why not many people is willing to put $1 million in their account. There is a catch-22 of the story. Yes.
I see. Okay, thanks a lot. I'm going to
Okay.
10:30 already. Yeah. Okay.
No problem. I'm okay. So I will upload this. So thank you everyone. So I hope that you will be able to see a different perspective to Colin's final remark. It has been 2 years, over years since I was back in Hong Kong to see my relatives, enjoy your stay, enjoy the food, and come home safe. Yes, I'll be back to Singapore on Wednesday night, and obviously Hong Kong is very hot right now. You know the weather here. So anyway, I'll be back to Singapore in 2 days' time. So I'll upload this video as soon as I can. And thanks everyone. So I will keep in touch with you guys in the Facebook group. So my parting remark is trade safe, secure, and prosperity, everyone. Okay, this is Jack Wong. I'm signing up now. Bye-bye.